Very good morning, class. So today we are going to begin with chapter number 3. That is very important chapter. Totally theoretical chapter is there. So the name of chapter, that is Theory Base of Accounting, Accounting Standards and Indian Accounting Standards. So in this chapter we are going to understand, we are going to read all the principles or the rules of accounting systems, and especially we will discuss here over the Indian accounting system that is very popular by the name of Indian AS. AS stand for Accounting Standards. So before the starting of chapter, we have to discuss over the topic accounting principles. So principles are nothing. Principles are the set of rules which we have to follow for doing any kind of activities. Okay, so principles can be understood by the way of set of rules, set of law. So here we have with definition of accounting principles, concepts and conventions commonly known as generally accepted accounting principles, that is called GAAP, GAAP. Accounting principles are the basic rules that define the parameters within which accounting operates. These principles are the theory base of accounting on the basis of which financial statements are prepared. As at the very beginning we have already discussed, in the accountancy we have to follow some rules or the regulations while recording our financial transactions. So all the concept, all the convention, it means all the rules, regulation or the set of principles by which we use to record our transaction, our financial transactions, that is called accounting principles. In India, the Institute of Chartered Accountants, ICAI, the Institute of Chartered Accountants of India, has issued accounting standards to the accounting practices adopted to prepare financial statements. The accounting standards issued by ICAI are applicable on non-corporate enterprises. The accounting standards notified under the Companies Act 2013 are applicable and mandatory on companies. So in India, Institute of Chartered Accountants of India set the parameters, provides the rules, regulations or the set of principle which should be followed by all sort of the business organization. Especially in India, all the companies, they have to prepare their final accounts or they have to prepare their financial statement according to Companies Act 2013, and that is mandatory for all. Okay, so accounting principles. Then after, here we have meaning and definitions. First, definition of accounting principles given by AICPA, American Institute of Certified Public Accountants. They defined accounting principle as principles of accounting are the general law, rules adopted or proposed as a guide to action, a settled ground or basis of conduct for practice. So according to this definition, accounting principles are the general law and the rules which we have to generally follow while recording our business transactions. That is adopted, it means most of the business organization follow, or proposed, it means that organization has proposed, given these rules or regulations for the just to follow this. Okay, so it's kind of guide towards our action. So in the business organization, whatever business activities we do and whatever activities we use to record, that is called settlement. Okay, for that these accounting principles help us. And one more meaning is given here. Accounting principles are the rules adopted by the accountants universally while recording accounting transactions. They are the norms of the rules which are followed in accounting of various items of assets, liabilities, expenses, incomes, etc. Okay, so accounting principles as same, that is kind of rule which are which has been most probably adopted by all the business organization by their accountants just to record their financial transactions, and these principles are generally that is just only the norms or the rules. which are followed to record different kinds of the assets or the liabilities. Basically, accounting principles are classified into two different categories. First is called accounting concept and second one is called accounting conventions. So here we have to discuss the term accounting concept as well as the accounting conventions. So what is accounting concept? We are aware about the term accounting and we know the meaning of concept. So concept, that is the basic things, general things or the general tendency which we have to follow. Okay, so accounting concepts are the basic assumptions, are fundamental propositions within which accounting operates. They are generally accepted accounting rules based on which transactions are recorded and financial statements are prepared. Accounting, that is just only the general or the simple concept which we used to follow in the business organization. Okay, and accounting conventions are the outcomes, that is simply the results which we used to achieve in the business organization while preparing different kind of the records or different type whenever we maintain different type of the registers. So accounting conventions are the outcomes of accounting practices, it's the principles being followed by the enterprises over a period of time. Conventions may change within time to bring about improvements in the quality of accounting information. As we have already discussed in the very beginning of the topics, that in accounting there is chance of the improvement. So accounting conventions, they are the changes which can be in the future just to make our accounting information more qualitative. Okay, so accounting concept, that is basic assumptions जिसके ऊपर में हम लोग बिलीव करके किसी एक्टिविटीज़ को परफॉर्म करते हैं. And accounting conventions, that is our outcomes, that is our end results which we try to achieve in the business organization. So here we have different fundamental accounting concepts and we have to learn and we have to remember all these concepts, all these principles. Okay, because all these principles will help us throughout the session जब तक आप लोग कॉमर्स स्ट्रीम में रहते हैं. So first and the very important principle, that is accrual principle. Second one, conservatism principle, consistency principle, cost principle, economic entity principle, full disclosure principle, going concern principle, matching principle, materiality principle, monetary unit principle, reliability principle, revenue recognition principle, and last, that is time period principle. Okay, so we have to discuss over all these concepts or the principle in this video lecture. So first and the very important principle, that is accrual basis of principle. So what is accrual principle? This is the concept that accounting transactions should be recorded in the accounting periods when they actually occur rather than in the periods when there are cash flows associated with them. So according to accrual principles, we have to record all the business transaction when it took place, not at the time of the final settlement. This principle we can understand with the help of an example. Suppose you are a seller, you have your own showroom, it may be the electronic showroom. So in that showroom, you used to sell your one of the product to your customer, okay, to whom you know very well. It was a credit transaction. So when you will record this transaction in your book, at the time of settlement, it means when you will receive or when you will realize the amount from your customer, or at the time of selling of goods. So this principle clearly instructs us we have to record the transaction when it took place, at the time when we used to sold the goods to our customer. At the time we have to record. It means we have to record as a credit transaction. We don't have to wait for the final settlement for the realization. Okay. The next we have conservatism principle. So according this principle, this is the concept that you should record expenses and liabilities as soon as possible, but to record revenue and assets only when you are sure that they will occur. So conservatism principle clearly instructs us we have to record all the expenses and losses in the business organization, okay, as soon as possible, and we have to record all the assets and all the profit, all the gain when you are sure that you will get this, okay. So this principle we can understand with the help of another example. In the business organization, if we think in the future, in the upcoming future, there may be the loss of 10,000, that is not the actually, but it may be. So if that is supposed to be lost there, we have to record it immediately. We don't have to wait for that, okay. If in the business organization there is a chance of profit or the gain, so that we don't have to record till the final realization. So in the business organization, we have to record all the expenses, all the losses if they are supposed to be there, but we have to avoid to record all the profit and the gain. Next, third principle, that is consistency principle. This is the concept that when you should adopt an accounting principle or the method, you should continue to use year after year. So according to this principle, we have to adopt, we have to use only one method of accounting. As we have already seen, there are different methods of accounting, okay, double entry system, single entry system and all. So at the very beginning, we have to select one of the accounting policy and we have to continue with that only year after year. Next, we have cost principle. This is the concept that a business should only record its assets, liabilities and equity investments at their original purchase cost, okay. So this principle clearly states we have to record the value of any asset, liability or equity, that is also called capital, at their original purchase cost. Whatever amount we had purchased for that asset, liabilities or the equity, that amount we have to record in the books only. Suppose if we have purchased any asset by paying rupees just 50,000 and we spent 10 more thousand just for the installation of that assets, so the cost of that asset is 60,000, not the 50,000. So in the book of account we have to write 60,000 and accordingly we have to deal. Next, fifth principle, that is economic entity principle. This is very important principle. This is the concept that the transactions of a business should be kept separate from those of its owners and other businesses. In the business organization, business and business owner, they are two different identity, that is called entity here. They are two different units, okay. So whatever transactions we will do on the behalf of business organization, that only we have to record in the books of account. Personal transactions done by that business owner, we can't record in the books of accounts. Personal transactions should be recorded in personal somewhere else, but in the business we have to record only business transaction. That is called economic entity principle. Next, sixth principle, that is full disclosure principle. This is the concept that you should include in or alongside the financial statements of a business of the information that may impact a reader's understanding of those statements. Full disclosure principle, it means whenever you prepare any kind of accounting information, when we adopt any accounting policy or the accounting method, so at the last once when we prepare our financial statement, it should be understanding for all the users of accounting information. Next, seventh principle or the concept, that is going concern principle. Here the meaning of concern related to the business organization. So, in this principle, this is the concept that a business will remain in operation for the foreseeable future. There is no intention to close the business or scale down its operation. So, according to this principle, business organization should be continued in the upcoming years. It should not be closed within 2 months, 3 months, or 1 year, because in the business organizations we do some expenses which we can write off in the next upcoming 4 or 5 years. For the example, just we are well aware about the new telecom company, that is of Geo. They have spent lot of amount for the advertising purpose, okay, and that advertising cost they will write off in the next 3 or the 5 year. How? Suppose if they are going to write off, it means if they are going to show all the expenses in the business organization only in that particular year, so their balance sheet will show them losses, okay, and that loss will decrease the value of their shares. So whatever amount they have spent on the advertisement, they will write off that loss or the expenses in the upcoming years. How? Just imagine they have spent nearby 30 crore rupees in on the advertisement, okay. So that is a kind of example. So that 30 crore they will write off in the 5 year. It means every year they will write 6 crore, 6 crore, 6 crore. So that's why that business organization should be continue at least for the 5 year. So after the going concern principle or the concept, next we have matching principle. This is the concept that when you record revenue, you should record all related expenses at the same time. This is cornerstone of the actual basis of accounting. So in the business organization, for recording all the income, there should be some expenses, okay. So at the time of recording of transactions, we have to record all the aspect, as well as income aspect as well as expense aspect, okay. So next we have materiality principle. This is the concept that you should record a transaction in the accounting records. If not doing so might have altered the decision making process of someone reading the company's financial statements. Materiality principle clearly state this is the concept that you should record a transactions in the accounting records, because each and every record affect our financial positions or the financial statement. So in the business organization, just to get the materiality information, materialistic informations, we have to record each and every transactions. Next, monetary unit principle. This is the concept that a business should only record transactions that can be stated in the term of a unit of currency. As we have already seen at the very beginning, we have seen in the business organization, we used to record all the financial nature of the transaction. And this is the concept that according to this concept in the business, we have to record all the transactions which has some monetary aspect. Then next we have reliability principles. Under this principle, this is the concept that only those transactions that can be proven should be recorded. For example, a supplier invoice is solid evidence that an expense has been recorded. Reliability principles, it means for recording of a business transaction, there should be any kind of evidence, okay. So once when you will purchase any kind of goods, so for that invoice given by your supplier, that is a solid evidence and solid proof. So accordingly we can record our transactions. The next principle, that is revenue recognition principle. This is the concept that you should only recognize revenue when the business has substantially completed the earning process. So when we have to accept that any transaction has been done in the business organization or not, so for that we have to follow revenue recognition principles. According to this principle, when we realize the amount of any transactions, at that time it should be completed, at that time it should be settled down. Okay, then next and the last concept, that is time period principle. This is the concept that a business should report the results of its operations over a standard period of time. So according to this principle, in all over the world, almost all the transactions are settled down within the duration of 12 months if they are of uh, nature of current assets or the current liabilities. Okay, so after this we have next and the very important topic, that is something about the history of accounting standards and their development. As we know, accounting standards, they are developed just after doing lot of experiments, lot of research, lot of practical assignments, then only it has been implemented. Okay, so in this content, in this topic, we are going to discuss over the process how the accounting standards developed. So as we know, the history of accountancy is not too old in the way of literature. Okay, the evolution of the international accounting standards began in 1966 with a suggestion to set up a worldwide study group. Basically, before the 1966, we were aware about the recording of business transaction, but after 1966, there was a international accounting standards. Okay, it was suggested to make a kind of accounting standards by which a businessman can use to record their transactions. Then the next year, in the year of 1967, the Accountants International Study Group was formed, and it began to publish papers on various accounting topics, some of which formed the foundation for accounting standards that came into force later. So just after 1966 or the 1967, a group of accountants, they started to publishing their articles, their rules, or the set of law how to record business transaction in the different newspapers or the magazines. Okay, and some of their accounting standards were come into force to record the business transaction. In the year of 1973, the International Accounting Standards Committee IASC was set up with the objectives of developing accounting standards that would be internationally followed. So in the year of 1973 only, International Accounting Standards Committee, it was set up just for the objective to make such a kind of standard which can be internationally adopted or followed by each and every business organization. The IASC issued a series of standards called the International Accounting Standards, named and numbered from IAS to IAS 41. So, International Accounting Standard, they have issued a list, a number of accounting standards, that is begins by the IAS 1 to IAS 41. So here we have the history of accounting standards. In 2001, the International Accounting Standards Board, IASB, formed under the International Financial Reporting Standard IFRS foundation replaced the IASC. At the very beginning there was IASC, International Accounting Standard Committee. It was replaced by the International Financial Reporting Standards, and the IASB, International Accounting Standard Board, announced that it would follow the standards already issued by the International Accounting Standard Committee. So at the very beginning, whatever rules or the regulation has been issued by the International Accounting Standards Committee will be used by the business organization for preparing their financial statements, but stated that any new standards would be known as part of a series called the International Financial Reporting Standards, and they have clearly stated that for the recording of transactions they will follow the rules given by IASC, but later on if any kind of new standards will come into the knowledge, it will be known as IFRS. So the objectives of IFRS is to develop in the public interest a high quality set of comprehensible, internationally accepted and enforceable accounting standards. So the main purpose of IFRS to develop the set of rules which can be used by all sort of the business organization for preparing their financial reports. The IFRS Foundation, an independent not-for-profit organization, raises funds from banks and other organizations that desires to have international accounting standards in place in all countries. Okay, so जो IFRS है फाउंडेशन, ये एक इंडिपेंडेंट नॉट फॉर प्रॉफिट ऑर्गेनाइजेशन है. प्रॉफिट अर्न करना इसका कॉन्सेप्ट नहीं होता है, और ये अपने आप को ऑपरेट करने के लिए अलग अलग बैंक से फंड रेज करती है. ओके, और इसका मेन पर्पस जो है दैट इज़ जस्ट टू डेवलप इंटरनेशनल अकाउंटिंग स्टैंडर्ड्स which can be adopted by all the countries. So the IASB consists of board members who are accounting experts drawn from all over the world and who are well versed in standards setting and academic works.